In this video, we're going to go over 8 stocks you're going to want to keep your eye on this week. All 8 of these companies report their latest earnings, and with how volatile the market has been as of late, even good earnings could send shares going down, making a great buying opportunity. Last week, we suffered through the worst stock market decline since the month of March, so a lot of top stocks are actually on sale right now. We're seeing declines of 5, 10+% in a lot of the major brands across the globe. So in this video today, we're going to go over 8 different companies who are all reporting their latest earnings this week, and these earnings report hopefully lead to some volatility in the market, and we can get into some nice solid dividend paying and growth stocks at good valuations. So if you're new here, I am the Gen Z investor. Every single Sunday, we go over stocks to keep on your watch list for the upcoming week. These are companies that either have some major news coming out, a new product launch, or an earnings report. And because we are right in the midst of core earnings seasons, every single company on this list, all 8 of them report their latest quarterly results. This week, we're going to go in order from starting earnings reports coming out on Monday and work down the week. So please hit that like button and subscribe. The first high growth stock you're going to want to keep on your watch list this week is PayPal, currently being traded at $186 a share. Over the past 12 months, they are up close to 75%. Currently trading at a market cap of $218 billion, this company has seen a nice pullback away from their 52-week high of $215 a share. And if we take a look, over the past month, we've seen a massive pullback in PayPal. When they peaked near their 52-week high, we're seeing over a 12% decline from that most recent high only 2 weeks ago. So now is a great time to jump into PayPal. We like buying solid companies with growing revenue, growing net income each and every year with a strong outlook for the future, especially when they're on a 12.5% dip. So they're expected to report earnings this week. They report on Monday, and last quarter they beat by both earnings and revenue. And over 3 of the past 4 quarters, we see 3 beats and 1 miss. Moving forward over the next 4 quarters into the future, analysts are expecting some massive growth from PayPal. In this quarter, these results are expected to grow earnings by over 54% year over year. In consecutive quarters after that, we're seeing 24% year over year growth, followed by another 52% growth. And if we take a look, this quarter, they're expected to post earnings per share of 94 cents and revenue of $5.4 billion. And over the past 3 months, we've seen 14 upward revisions of earnings per share estimates and only 2 downward revisions. So analysts have just shown that over time throughout this quarter, they're getting more optimistic about how PayPal will perform and have been bolstering up their earnings per share estimates. So this is the first high growth company that may be a great buy this week, especially if we see another dip post earnings report, because getting this company already on a dip of 12%, this is a brand that helps facilitate digital and e-commerce platform payments that I believe will continue to grow for a long period of time. The second stock is Clorox, ticker CLX, currently at $207 a share. They are up 37% this year, but have been on a pullback over the past few months. And this company, of course, creates those sanitary products that are only growing in demand as time goes on. Because of the pandemic, the need and higher cleanliness standards are only going to stay and actually grow over time. And Clorox is one of the name brand, household brands that people trust for their sanitary and cleanliness goods. So this company currently trades at a market cap of $26 billion, and you can see here, it's kind of in the middle on the 52-week range. A significant pullback away from the 52-week high of $240 a share. This is a dividend-paying company, and if we take a look on the 6-month chart, they're down over 12%, close to 13% decline from their most recent high a couple months ago. So this company provides products, cleaning solutions that are continuing to be in demand over the next 5+ years. No matter once the pandemic is under control, their products are still going to be sought out and still going to be highly regarded in the marketplace for a long period of time. So a company like this, who sells products that are continue to grow and the demand for the products are going to continue to grow as well, might be a nice addition to your portfolio. So they're expected to report on Monday as well. They're expected to see earnings per share of $2.22 and revenue of $1.74 billion. This company does pay out a dividend and is currently yielding 2.14%. They pay out 58% of their earnings as a form of a dividend, so they have a sustainable payout ratio that has room to grow the dividend and to keep money back into the business. They also have a 5-year dividend growth rate of 6.86%. So a very nice dividend growth rate. You're locking in an average yield starting at 2%, but your dividend is growing at a rate of close to 7% averaged each and every year. And they have a 43-year dividend growth streak. So they're on their way to becoming a dividend king. They are, of course, a dividend aristocrat, and 7 more years of dividend growth, which I'm sure they will achieve, will make them into that well-established dividend king status, which is absolutely incredible. So this company has been able to weather good times and bad times in the market, and I feel like this pandemic has only shot up the demand for their goods, and I believe moving forward, we will see Clorox continue to grow. Stock number 3 is Waste Management, ticker WM, currently at around $107 a share. They are actually down 4% this year, but over a longer term perspective, on the past 5-year chart, shares are up over 100%. Market cap of $45 billion on this company, trading in the middle of the 52-week range. So another company that's seen a pullback, and as of late you can see on the 1-month chart, they are down over 4%. So this is a company where, regardless of the economic situation, people are still going to create waste. Even if the waste is still reduced, there's still going to be continuous operations for waste management regardless of what's going on in the world. So if we take a look at their earnings report, they report on Monday as well, and they are expected to post earnings per share of $1.02 and a revenue estimate of $3.74 billion. This is another company where if you want to buy a stock with continuous operations that pays out a dividend, this is one you may want to take a look at. They're currently yielding 2%. They've been growing their dividend for 17 consecutive years, and they grow their dividend at a rate of over 6.4% averaged over the past 5 years. So an average growth rate with a nice starting average yield may be a nice addition to your portfolio, especially if you want to get into the industrial sector, kind of diversify away from some of the main sectors of the market, such as tech, healthcare, consumer. Diversify your assets into various sectors and different operations and different business models. They pay out only 56% of their earnings in the form of a dividend, so lots of room to grow earnings, grow that net income number by reinvesting money back into the business, and to, of course, grow the dividend payment like they've been doing for consecutive years already. Qualcomm is the 4th stock on our list today. Currently trading at $123 a share, they are up over 51% on the 1-year chart. On a 5-year chart, they are up over 107%. They have a market cap of $139 billion. Over the shorter term as well, you can see a slight pullback from their recent high of around $130 a share over the past few days as the overall market has been declining as well. With regard to their earnings, they report on November 4th. So we're done with November 1st, we're moving on a couple days down the road. November 4th, they're expected to report revenue of $5.94 billion with earnings per share of $1.18. And over the past 4 quarters, they've done a nice job of beating analyst expectations each and every time. And over the next consecutive quarters, we're expecting a massive growth year for Qualcomm. 51% year-over growth this quarter, followed by 3 consecutive quarters of 68% growth, 63% growth, and 79% year-over-year growth. So absolutely massive estimates for Qualcomm moving forward. So this may be a nice stock to pick up if they see a nice volatility over this next week, especially with the 5G network coming out and a lot of expansion opportunities for Qualcomm moving forward. If we take a look at their dividend, currently yielding 2.11%, 5-year dividend growth rate average of 9%, which is great to see, with a 10-year dividend growth streak. And they pay out around 66% of their earnings in the form of a dividend, so below the threshold of 70 to 75% of payout ratio, which is kind of where the max you want to set it at for a dividend paying stock. So they are below that threshold. They have enough money to pay out the dividend, continue to grow it, and reinvest the money back into the business. The next stock we're going to discuss is Mercado Libre, ticker symbol MELI, currently at over $1,200 a share. They are up over 120% this year, and this is called the Amazon of Latin and South America. This is one of the largest e-commerce platforms down south. They are the Amazon of the southern countries in the southern Americas. They currently trade at a market cap of $60 billion and have seen a slight pullback away from their 52-week high. This company, of course, the e-commerce world is only growing, and this company has some high growth rates moving forward as well. They're expecting earnings per share of 21 cents and a revenue of $980 million. If we take a look at their income statement, they've seen some beautiful total revenue growth year over year, Nice exponential growth as the e-commerce market continues to expand, and of course, as the pandemic has shifted people to buying more goods online, this is another brand that is expected to perform very nicely over the next 5+ years, and may be a great addition to your portfolio if you want to get some diversified income, even some growth stocks from maybe some international brands, such as Mercado Libre. This may be one you want to take a look at because they report earnings this week as well, and their earnings report comes out on the 4th of November. Another one of the largest companies on the market reports their latest earnings this week, and that is Alibaba, ticker BABA. This is in the top 10 largest companies in the world with a market cap of $824 billion. They are up 71% over the past 12 months, and another e-commerce platform that has been growing at an exponential rate. Their platform, of course, because of the pandemic, continuing to affect the global economy, their overall platforms and their e-commerce network has been growing rapidly quarter over quarter. And if we take a look at this company, they're expected to post earnings per share on November 5th of $2.10 with revenue of over $23.15 billion. Over the past few quarters, they've beaten on revenue and earnings expectations each and every time by significant amounts, beating by 35 cents, 35 cents, 43 cents, and 18 cents over the past 4 quarters. And moving forward, we're seeing nice exponential growth. This quarter is expected to see over 12% year-over-year growth, followed by 18%, 44%, and 36% annual growth rate over the next 4 quarters. And if we take a look at their income statement, this company has some solid fundamentals. Total revenue growing at an exponential rate, $15 billion of total revenue in 2016, all the way up to over $77 billion in the past 12 months. That exponential growth is ridiculous, more than quadrupling their revenue in a matter of 5 years. And if we take a look at net income, they've posted positive net income each and every year, and they have extremely high profit margins. $24.8 billion of net income on $77 billion of revenue. These extremely high profit margins make this one of the top stocks to put in your portfolio if you want to get into another e-commerce brand that is expected to grow over the long term as well. Moving on, the next stock is Square. We already noticed that PayPal is reporting earnings early on in the week. Square, their main competitor, is reporting at the end of the week as well. So this company's up 149% over the past 12 months, but over the past month, you can see a recent decline and shares are down over 4.5%. On the last market day of trading, shares dropped over 8.5% in one single day. They have a market cap of $68 billion, and of course, this is the company in the payment solutions in the financial tech sector that is expected to grow and continue to expand over the long term. And they actually made a recent announcement that they spent over $50 million to purchase Bitcoin, making it a total of 1% of the total assets on their balance sheet in Bitcoin, which is very new. That's something that's kind of unique for a company like this to put 1% of the total assets into a cryptocurrency, but they were the first to do just that, and we will see how it pays off. They're reporting after-market close on November 5th with earnings per share of 16 cents and a revenue estimate of just over $2 billion. So if we take a look, we're going to move on to the final company, stock number 8 on our list today, and that is Duke Energy. We have a high-yielding stock to take a look at this week, currently being traded at $92 a share, down 2% over the past 12 months. This is a utility company that provides nice consistent dividend payments that are growing each and every year. Trading towards the middle on the 52-week range, market cap of $67 billion with a dividend of over 4%. They're expected to post earnings per share of $1.80 and revenue of $7.34 billion. If we take a look at their dividend, with a current yield of 4.19%, they pay out around 76% of their earnings as a dividend. For a utility company, that is safe. Utilities have very consistent and predictable operating cash flows, so this 76% payout ratio is still considered safe as a utility company. They grow their dividend at a rate of 3.5% averaged over the past 5 years, so you are getting dividend growth rates slightly outpacing inflation each and every year. So those were 8 different companies, various sectors of the market. We have a nice diversified list this week of some high growth stock, some high dividend stocks that all provide you their earnings report over the next few trading days. And like we saw last week, if the red continues to go down, if we see more declines in the market, we see more of a sell-off, some of these high brand name companies that are going to be around for a long period of time might be a great opportunity to jump in and buy the dip. Even if we don't see the most recent dip of like 20 to 30% again like we saw in the month of March, getting any company for 10% off is always a good deal. So thank you for watching, everyone. I am the Gen Z Investor, and see you in tomorrow's video.